Hello, good people, and welcome to Finance Skills Hub. Here we learn, we connect, and we grow. This is a special video. What we want to do is to break down the concept of financial modeling. For most people, even in their finance and accounting space, it can be a bit abstract. What does it look like? From assumptions to valuation, how do I build it? What are some of the certifications that I can use to add some value to my career? We want to take all that in this video. So if you're able to watch to the end, I have a special package for you that can enable you build a financial model from scratch. So if you're game, join me and let's get started. Right, so before we begin, let's understand that a financial model is a decision-making tool, especially when it comes to making an investment that involves money. It is supposed to guide you. It is supposed to make sense of a real-world business situation which you have created a concept or a model to represent that real-world business situation. So without taking you too far, even a simple personal budget for next year can be deemed a financial model. Now we use spreadsheets to make it easier for us to manage the inputs. The inputs are supposed to be flexible. So in our assumptions page, we put in the assumptions in such a way that it drives the final outcome. Normally, the popular outcome for financial models is to build what we call a three-way integrated model. Normally, you work towards building the income statement, the balance sheet, and the cash flow. These three core financial statements are used to assess profitability, use of assets, cash flow, and all those things that would make it easier for us to see our returns, especially when we are making a decision. Maybe we are branching out, we are acquiring a new business, or we are even getting a new asset. That's bottom line is why sometimes we go through the process to build a financial model. Now, this is the front end of our financial model, a model for an airline company. Now, you'll notice here that for the key takeaways, we have an actual or historical period that was from 2017 to 2019 and a forecast period from 2020 to 2024. Now, because financial models are supposed to be flexible, this actually has a base case, a best case, and a worst case. Okay, so if I choose a revenue point and I want to test the best case scenario, I'm able to test and then see what I'm likely to get based on the assumptions that I've used. We normally want to bring out or highlight the key things that the investor or the user is interested in. So example, revenue, which is a top line, is always highlighted. Earnings before interest, tax, depreciation, and assets. Closer to operating profit or cash, okay, is also highlighted. Net income to common for shareholders. It will depend on what you want to report on. But the point is that all these numbers you are seeing here are not cast in stone. They are driven by assumptions. And typically, when we build financial models, we start with assumptions. The convention is that these assumptions are normally formatted in blue fonts. Okay, so for a typical business, if you want to build a financial model, you probably want to start off with historical data, financial statements. Okay, use that as basis, and based on their performance for those historical periods, you can use those numbers to forecast. Find an average or something that can help you forecast accurately. Okay, so normally you have a timeline that has an actual period and a forecast period. Usually 3 to 5 years forecast period is acceptable, unless it's an investment that requires a longer term for planning. Okay, so when you see an assumptions page, the basic idea is that the user here is putting in drivers or inputs that would give or direct the outcome of the model. It could be dates, okay, it could be the number of seats. In this case, is an airline, okay. We want to also know the sales, how much it's going to cost us, the assumptions for our assets, current, and the ones we are going to acquire, our working capital balances, our debtors, and all those things. Normally, we like financial models in a spreadsheet because the spreadsheets allow us to capture at very granular levels, if you like, the point where you cannot break down further the assumptions that will drive our models. Okay, so we want to be as detailed as possible, sufficient enough to drive the model. So when you see a typical financial model and then you see an assumptions page, basically that is your starting point to be able to put in flexible inputs that will drive your calculations and your final output. Because financial models are not cast in stone, we normally want to give the user a way to flex or play with some key indicators that would affect the model. Typical example will be inflation. Normally, if you build a model in just 6 months down the line, the whole model will change because inflation, especially in this part of our world, doesn't stay still. Okay, so you can actually bring out some of these key drivers and then flex them. What we mean by flexing is that you set them to base case, best case, and worst case scenarios. When you are working with a model, you can actually activate any of these scenarios to see how it impacts the model. So normally we'll add a scenarios page. Then you also have what we call a schedules page. This is where you do your calculations. Very important. It has to be set out in such a way that any user can see how, example, your revenue came about. Okay, so in this case, if I want to calculate revenue for the airline, the drivers for the revenue will be the number of seats per kilometer, and other auxiliary income like cargo sales. All these have to be calculated bottom up, okay, in such a way that the user is able to audit and then see how you came by these numbers. Not just revenue, but operating costs, long-term assets, right? If you have an eye for financial statements, you realize that the way this is broken down, it is basically our financial statements that we've broken down to make it easier so that when we are done, we can just sweep these numbers to the income statement, the balance sheet, and the cash flow. So things like calculating depreciation using the waterfall method, all these that take into account your existing CAPEX balance and what you hope to acquire in the forecast period are all taken care of here, right? So there's typically a schedules page which allows you to calculate backwards, if you like, all the lines in your financial statement. Then when you are done, you can now sweep all these calculations into your financials, right? So you now have your income statements. The typical lines are here from revenue to net income. In some cases, you want to even add net income to common after you've taken away preferred dividend. Then you have your cash flow and you have your balance sheets. Okay. Normally, if you open a financial model and you see circular referencing, it is allowed in cases where you have to deal with cash balances, right? Sometimes in an overdrawn position, when you have an overdraft, your cash balance accrues interest. If you have an excess, your cash balance also accrues interest. You build it as a living document that loops so that all interest, whether it is in excess or it is an overdraft, is calculated as part of your final balance sheet numbers, right? So that is why sometimes you find that we bring in some features like the circuit breaker to handle this. Of course, you can always take this away. We'll show you when it comes to how we built this. Okay. Then when you are done with the base requirements, which is building your income statement, your balance sheet, and your cash flow, sometimes you want to take the extra effort to do valuation. Okay, for investment decisions, people want to know how much the whole venture is worth. Okay, so you can now use the assumptions from your financial statements to calculate your valuation. Okay, and again, these valuations can be made flexible using sensitivity analysis and all that. Okay, so if you're getting into this space, normally, especially if you work in an investment sector, money doesn't go out without a financial model. People want to see that what we are putting our money in, this business we are acquiring, this branch we are creating, is it worth it, based on historical data and some drivers and assumptions. And that is why we normally want to create a financial model. Now, I want to break this down further for even those who are pretty new to this. If you are not a finance or accounting person, this next 5 minutes is for you, where we take it back to basics, financial modeling 101, to help you appreciate what it means and then how we can take it from scratch. So if you want to know how to build this from scratch, from an empty Excel worksheet, we put together this full course that allows you to build the same case study I showed you. What that case study does is that it helps you build the required skill, the shortcuts that you need in Excel. It also introduces the accounting concepts, how to link the income statement to the balance sheet, to the cash flow, and in a way that would make it possible for your valuation to even make sense. You learn best practices with setting out your layout for the assumptions page, the scenario page, the calculations or schedules page, sweeping your numbers to the financials, setting scenarios and all that, right? I've shared a link to this course on our website, financeskillshub.com. You visit courses and you are able to subscribe. Okay. There's also a discount code for those who are watching this video that has been shared in the video description as well. With that done, let's go to financial modeling 101. Right. So for those who are new to financial modeling, we want to use the next few minutes to break it down. What is a financial model? Why do we do it? I've covered a few concepts prior to this, but I want us to focus on the basics. Okay. You'll be surprised to know that the concept actually is in the Bible. So there's a point where Jesus speaks about the need to plan if you're going into a venture. So in this case, the example he used was somebody going into a building project or going into war. The need to count or plan for your resources. You're able to lay it and then see what you can afford and what the expected outcome is. You're not likely to run out of resources. So I mentioned that even something as simple as a personal budget that allows you to plan for next year is an example of a financial model. We do it so that we can actually have a sense of a real world business situation broken down in a way for us to analyze the inputs. Okay. So that if we can make profit, we'll know. If we cannot make profit, we'll know what we need to adjust. Is it price? Is it to reduce our cost? Is it to expand further? All these will be clearer when you are able to lay it down in numbers, if you like, in this case, with financial models. So that's why I started on this note. That is something that we can relate to even in the Bible. But the point here is that there are key things that stick out when you are defining a financial model. It is a real world business situation. You are basically trying to model it, create a copy, okay, a conceptual model for that matter, to help you understand what you are going into. Anything that involves money requires you to break down into granular level what is bringing in the money, what is taking away the money. We normally will use a spreadsheet, okay, example Excel or Google spreadsheet, to help us capture the details of what is driving the outcome, okay. So when we do that, we are able to likely pick on something we may have not paid attention to, maybe some cost overruns or the need for timing. Sometimes when you buy an asset can determine whether you make a profit or not, okay. Then you can get some insights which will help you interpret your model and you make the decision. Should we go on? Should we wait? Should we reduce our prices and all that? Okay. Then you can now move on and make your decision. But the way it is supposed to be a guide. Okay. So we make the inputs flexible. Sometimes we use historical performance of the company, relying on past financial statements to make this possible. So the key words here is that one is an abstract representation of a real world business situation or financial situation. It normally would use numbers or math. It helps us also forecast business dynamics, okay, and is driven by assumptions or historical data, right? So what is financial modeling in essence? These are the key words. It is supposed to be a living document. You can make changes. You can set scenarios. Okay, I've mentioned that you are comparing a real world situation and building a model, a copy of it using your spreadsheet to guide you with strategic decision making. Okay, so we've covered the key details. Normally, the part of a financial model, depending on the task, the deadline, or information available, can be fairly broken down into three sections: the inputs, your calculations, and your outputs, right? It will depend. But typically, your inputs will be the assumptions, the blue numbers that you saw earlier. Okay, how much are we going to sell our food items? How many people are we anticipating will sell to? Of course, you have not ventured out yet, but these are plans. But you put them in such a way that you can vary them. Okay, so when you put in these assumptions, to get revenue, you have to calculate, multiply the number of people you want to sell to by the expected price. Okay, so you put in schedules to calculate, right? In detail, some of these schedules support your financials, your revenue, your cost, your operating expenses. All these can be broken down. You build them in such a way that they are auditable, even for yourself. So sometimes when you come to a financial model, you need to be clear on how you came by the key numbers, right? So you get your financials as part of your calculations. Then, based on what you've achieved with your financials, you can now create outputs that will help you make decisions, right? So sometimes you can use those results to do valuation or break-even analysis. Okay, you can set the results to scenarios: base case, best case, worst case. Okay, or you can even stretch it a bit to do what we call sensitivity analysis based on the outcome, so that you're able to see the impact of the variables that you have in there, right? So it is something that is responsive, it is dynamic, it changes as your assumptions change. If you look at this architecture, what it means is that every time you make a change in the assumptions, something would come up or change in the financials or your final output, right? Now, let's look at the typical uses. So here, in a very advanced model, you can use it to raise capital. If you're a new business, you have a business plan, you would normally put a financial model in there, right, to give your investors a sense on whether your business is worth their money. Okay, if you're already an existing business, you also want to make acquisitions for smaller businesses. Yes, a financial model on that target business is also going to be useful. If you want to branch out, grow organically, okay, sell assets, business units, budgeting and forecasting, I mentioned, allocating resources, capital, or even value in a business. All these would involve a certain type of a financial model, right? It's not cast in stone. There are other applications of a financial model. The features of a good model, as you would have seen by now, is that it is not cast, it's not rigid. Okay, it is supposed to be flexible. So we normally avoid hard coding. You don't put in the price of the item in such a way that in the outcome or the formula work, it cannot change. Okay, everything that is calculated would have a source or an assumption that is driving it. So the cells are linked to the assumptions. Okay, now these assumptions will drive the model. So if you build it well, you can even make changes when any of those inputs change. Okay, because they are heavy, you need to ensure that you have consistent labeling to make it easier for yourself or your user. You cannot capture everything in a financial model. Okay, but it should have enough inputs to make your decision. This is what we call the sufficiency principle. Normally, the acceptable timeline is 3 to 5 years for most projects. But if you are using this for an agriculture investment example in this part of our world, sometimes 10 years is also an ideal time. Okay, then it has to be clear the structure and the design has to be very intuitive for users as well. These are some of the features of a good model, right? Now, I'll borrow the FAST standard. You can get details of this FAST standard from this website. They break this down into F, which is flexibility, okay? A, which should be appropriate. The model must reflect key business assumptions directly and faithful without being overbuilt, okay? So just enough to make sure that you don't lose sight of what you are building. It should be a good representation of reality, okay? It should be structured. So you saw that in our earlier model, we had everything laid out, from assumptions to scenarios to calculations to your financials, your valuation. This helps to maintain the integrity of the model, okay? Then you also have to be transparent. You're not building just for yourself. You are building for other users who may want to make changes to the model. Okay, so it has to be transparent so that we can audit what actually drove the outcome of the model, right? What are the skills of a good financial modeler? Well, some people think you just need to be an accountant. No, you don't even need to be an accountant. What you need is to understand the accounting equation, how the financial statements link up. The best modelers I know are engineers, okay? So yes, it helps to have spreadsheet skills, which is important. At least if you are using Excel, you need to know how to lock your cells, how to run if formulas, how to use date time. Some basic Excel skills would help, okay? So you need to improve on your spreadsheet skills. Then you need industry knowledge. You can't build models for an industry you are not clear on. If you're a consultant, you will normally want to spend some time with your client to get a sense of what is driving revenue, what is driving costs. Explain it in simple English so that you can translate it into numbers. So a bit of industry knowledge is also very important. Then there's accounting and finance. Because you are going to use numbers, this is also very important. Need not be an ACCA, CIMA, chartered accountant, but enough for you to learn how the financial statements link up. How do we create the income statement? What drives it? What is the balance sheet? What drives it? Cash flow and all those things. It helps. If you are new to this, you visit our YouTube channel. We have an Accounting 101 video to help you appreciate the linkages. Okay. Then aesthetics and design. Because models are number heavy, you want to learn the principle of laying out your worksheet very well for navigation, right? Your headings, your subheadings, the color code, all these make it easier for yourself or your user when you build your financial model. Okay, so these are very essential if you want to be a good financial modeler. So if you want to add some certification or learn how to build different models, these are sampled bodies or organizations that can help you, right? So there's the Financial Modeling Institute. They offer certifications for the Advanced Financial Modeler Program, Chartered Financial Modeler Program, and the Master Financial Modeler Program. Finance Skills Hub is an approved training provider for the Financial Modeling Institute. We've trained over 30 certified advanced financial modelers. So this case study that we used actually can help you even pass the exam if you go through back to back. Okay. Corporate Finance Institute, CFI, is also a very fantastic option if you want to self-learn. They provide the resources to allow you to get the certification at your own pace within a year. So you can complete all the modules. Wall Street Prep, Breaking into Wall Street, EduPristine. So all the concepts that we've covered, okay, we've used some of the resources from these people to make it easier for you to build on your career in financial modeling. So in the end, you can take any path, but I believe that with all these resources and bodies, you should be able to make a career out of financial modeling. Thank you so much for watching, and we'll see you in the next video.